Imagine going to the grocery store and finding that your usual basket of goods now costs significantly more. The items you used to buy without a second thought now make you hesitate as you see the price tags. This is a reality many are facing today. You're facing inflation, a steady increase in the general price level of goods and services in an economy over a period of time. Inflation can be driven by various factors, including increased production costs, higher demand for products, or even government policies. When prices rise, each unit of currency buys fewer goods and services. This means that the same amount of money you had last month now gets you less, forcing you to make tough choices about what to buy and what to leave behind. This leads to a decrease in purchasing power, the amount of goods or services that a unit of currency can buy. As your purchasing power diminishes, you might find yourself cutting back on non-essential items or even struggling to afford basic necessities. Inflation is often called a silent thief because it gradually erodes the value of your money. Over time, the savings you have worked hard to accumulate can lose their value, making it harder to achieve your financial goals. What you could buy for $100 a year ago might cost you $105 or even $110 today. This gradual increase can add up, significantly impacting your budget over time. This erosion of purchasing power can have a significant impact on consumers, especially those on fixed incomes or with limited savings. For these individuals, every price increase feels like a heavier burden. For example, retirees living on a fixed pension might find it harder to afford their essential needs as inflation pushes prices higher. Their fixed income does not adjust with inflation, making it increasingly difficult to maintain their standard of living. Similarly, families saving for a down payment on a house may see their savings goals become more distant as the cost of housing rises faster than their savings grow. This can delay their dreams of home ownership and create additional financial stress. Inflation can be a source of economic anxiety and uncertainty, making it crucial to understand its causes and consequences. By staying informed and planning ahead, you can better navigate the challenges posed by rising prices and protect your financial well-being. Inflation can stem from various factors, often categorized as demand pull or cost push inflation. These two types of inflation have distinct causes and effects on the economy, and understanding them is key to grasping the broader economic picture. Demand pull inflation occurs when demand for goods and services outpaces supply. This can happen in a thriving economy where consumer confidence is high, leading to increased spending. Imagine a scenario where consumers have more money to spend, perhaps due to government stimulus checks or a booming economy. When people have more disposable income, they tend to buy more, driving up demand. This increased demand can lead businesses to raise prices as consumers compete for limited goods and services. Retailers and service providers may find it an opportune moment to increase their prices, knowing that consumers are willing to pay more. On the other hand, cost-push inflation arises from increases in production costs, such as raw materials, labor, or transportation. When the cost of producing goods rises, companies often have no choice but to pass these costs on to consumers. When businesses face higher input costs, they often pass those costs on to consumers through higher prices. This can be seen in various industries, from manufacturing to retail. For instance, a surge in oil prices can lead to higher gasoline and transportation costs, ultimately affecting the price of a wide range of goods and services. The ripple effect of increased oil prices can be felt across the entire economy. Understanding the underlying causes of inflation is crucial for policymakers to implement effective measures to control it. By identifying whether inflation is demand pull or cost push, they can tailor their strategies accordingly. It also helps individuals and businesses make informed financial decisions. Knowing the type of inflation can guide investment choices and spending habits. For example, if you anticipate continued inflation, you might consider investing in assets that tend to rise in value during inflationary periods, such as real estate or commodities. These investments can provide a hedge against the eroding purchasing power of money. In conclusion, understanding the dynamics of inflation, whether it's driven by demand or costs, is essential for navigating the economic landscape. It empowers both policymakers and individuals to make strategic decisions that can mitigate the adverse effects of rising prices. Central banks play a pivotal role in managing inflation and maintaining price stability. They are the guardians of the economy, ensuring that the financial system remains robust and resilient. One of their primary tools is adjusting interest rates, the cost of borrowing money. This lever allows them to influence economic activity directly. When central banks raise interest rates, it becomes more expensive for individuals and businesses to take out loans. This can lead to a decrease in consumer spending and business investments. This can help cool down an overheated economy by reducing borrowing and spending. It acts as a brake on economic activity, preventing the economy from overheating and keeping inflation in check. Conversely, when central banks lower interest rates, borrowing becomes cheaper, encouraging spending and investment. This can lead to increased consumer confidence and business expansion. This can help stimulate economic growth during a slowdown or recession. Lower interest rates can act as an accelerator, boosting economic activity and helping to create jobs. By adjusting interest rates, central banks aim to strike a delicate balance, keeping inflation in check while promoting economic growth and employment. This balancing act is crucial for long-term economic stability. The decisions of central banks have far-reaching consequences for individuals, businesses, and the overall economy. Their policies can influence everything from mortgage rates to the cost of groceries. Higher interest rates can make it more challenging to afford a mortgage, car loan, or credit card debt. This can lead to financial strain for many households. On the other hand, lower interest rates can make it more attractive to invest in a new business, expand operations, or purchase a home. This can lead to economic growth and increased opportunities for individuals and businesses alike. Ultimately, the central bank's lever of interest rates is a powerful tool that shapes the economic landscape, influencing the financial well-being of nations and their citizens. Section 4. A tale of 5 economies, inflation and interest rates in action. Recent years have witnessed a global surge in inflation, prompting central banks worldwide to respond by raising interest rates. The United States, for example, experienced its highest inflation rate in decades, leading the Federal Reserve to implement a series of interest rate hikes. This aggressive monetary tightening aimed to curb inflation by slowing down the economy. Similarly, Canada, the United Kingdom, Australia, and Sweden have all grappled with rising inflation and responded with interest rate increases. While these measures are necessary to control inflation, they can also have negative consequences, such as slowing economic growth and potentially leading to a recession. The experiences of these countries highlight the challenges of managing inflation in a globalized economy. Factors such as supply chain disruptions, geopolitical events, and fluctuations in energy prices can all contribute to inflationary pressures, making it difficult for central banks to maintain price stability. Section 5. Global ripples, inflation's impact on trade and finance. Inflation's impact extends beyond national borders, affecting international trade and financial markets. When a country experiences higher inflation than its trading partners, its exports become relatively more expensive while imports become cheaper. This can lead to a decline in exports and an increase in imports, potentially widening the country's trade deficit. Furthermore, inflation can create uncertainty in financial markets as investors adjust their expectations for future returns. Higher inflation erodes the value of future cash flows, making bonds less attractive and potentially leading to lower bond prices. Investors may also shift their investments away from countries experiencing high inflation, seeking higher returns in countries with lower inflation rates. This capital flight can put downward pressure on a country's currency, making imports more expensive and potentially fueling further inflation.